Good morning. A warm welcome to our panel discussion, Tough Questions for a Hard Market, where we'll focus on insurer perspectives on the balance between client and shareholder needs. My name is Ben Rolfe. I'm the Chief Broking Officer for Aon here in Australia, and I'm joined today by Craig Langham, Regional Chief Executive for Asia Pacific at AXA XL, Dimitra Day, Head of Major Accounts Division, Australia and New Zealand at Chubb, and David Hoffman, Head of National Underwriting at Suncorp. Before we get into the panel discussion, I ask a couple of challenging questions to the panel. I was keen to just set the scene with a few insights into the macro trends impacting the industry, which I thought might help just frame the discussion going forward. So globally, successive years of poor insurer performance have been driven by three key factors. We're seeing more frequent and severe natural catastrophe events, rising loss activity and severity impacting capital adequacy, and social inflationary pressures affecting long-tail classes of business. These trends have been exacerbated by increased competition in the sector through a surplus of capital over a number of years that have been attracted to the industry's perceived non-correlated returns to investment markets in a low interest rate environment that we've seen for so long now. And despite recent portfolio remediation undertaken by insurers, this excess capital in the industry has hampered insurers' attempts to improve underwriting performance over that time. And we'll get into that conversation in a little bit more detail as we go, because I think that's clearly important. But what does this all mean? Well, Standard & Poor's revised their outlook for the global reinsurance sector to negative in May, and they predicted the sector would not earn its cost of capital in 2020. Indeed, it won't have done so for 4 years in a row. S&P also suggested that the top 20 global reinsurers would post a combined ratio in 2020 of between 101 and 105%. That was assuming the fact that COVID losses would remain within the $30 billion bracket, which many believe that will not happen. And locally, unprecedented bushfires and then subsequent storm damage earlier on this year has really just exacerbated these trends. And according to APRA, the net combined ratio, underwriting ratio for general insurers in Australia in the March 2020 quarter deteriorated to 111%, up from 94% in December 2019 and 90% a year earlier. So let's delve into these trends in a little bit more detail. And this slide will be familiar to many of you, I'm sure. But there's been a steady increase in capacity over the course of the last decade or so. But there seems to have been a bit of stagnation that's occurred in more recent times. And the continued poor performance of the industry is starting to have an impact on capital available and is leading to, for the first time, the supply-demand push-pull to actually shift in a different direction. You'll see here in the dark blue the alternative capital that makes up this overall capital within the market. And you'll see that in 2019 it dropped for the first time. And it dropped because investors were starting to see a lack of return on that promised investment. And whilst I think it's fair to say there are signs as we close out 2020 and move into 2021 that there are signs that will change, it's certainly material to what you're seeing insurers and reinsurers do today. And if we look at the natural catastrophe claims at a global and a regional level, you'll see here that there is a clear upward trend in these losses. And the traditional peaks and troughs that we've seen in the market for so long are not quite as clear as perhaps they once were. It's worth noting as well the emergence of bushfire, which you'll see here in green, and the growing prevalence of tropical cyclones in light grey to these overall numbers. And obviously, importantly, these are perils that we're very used to here in Australia in recent times. The graph on the right breaks this down by region, and you'll see that the APAC region definitely punches above its weight in terms of claims activity, considering the premiums in this region compared to the US, the Americas and EMEA. But you'll see also that the 10-year median is heavily dominated by 2011. So yeah, that's the Christchurch earthquakes, Brisbane floods, floods in Thailand, and of course the tsunami in Japan. And then finally, and I don't have a slide for this, but finally the third factor is claims inflation or social inflation, as many suggest, which is really sort of seeing the claims reserves deteriorating markedly. This has been driven largely by reward amounts in particular, but also things such as increased repair costs of cars with the ever-growing computerisation of vehicles. And there's a growing feeling that actuaries have got it wrong by not predicting these trends soon enough. And indeed, there's an estimated US dollar $100 billion hole in global reserves. And if we put that in perspective, that is equivalent to one of these larger spikes on the natural catastrophe graph in front of you. So given these macro trends, insurers are looking for profitable growth, and they're looking to try and do so via portfolio remediation and definitely a back-to-basics approach to underwriting. And in order to do this, insurers are looking at tools such as premium and deductible increases, coverage restrictions, stringent risk selection, and an ever more focused eye on risk management practices. I think the unfortunate thing is, in Australia at least, we're not seeing this make any meaningful difference to date. And in fact, if you look at the graph here, in March 2020, local property combined ratios increased to the same level that they were a year earlier. And in fact, only 2 of the last 10 quarters have seen loss ratios dip below 100%. And then we add COVID into the mix. So, insurers are now experiencing a dual shock affecting both sides of their balance sheet. We've spoken about the claims environment, and add to that, claims coming directly from COVID itself, and then the financial market turmoil through the COVID-19 pandemic. And if you look at the graph here, what we've done is we've plotted the Aon reinsurance aggregate, which is an aggregation of the data behind the major global reinsurers, and actually plotted that against the other major indices and financial markets. And you'll see there that despite starting the year strong, the industry is definitely lagging behind its peers at a global level. So I'm sure you'll agree I'm in a pretty bleak picture, and I hope it does give you some context as to why insurers are behaving the way they are at the moment. I might pause, and before we get into the panel discussion itself, I might actually ask the panel whether they've got any thoughts or observations about what I've presented.
I think all of the issues that you've addressed are creating the current environment. I think there's one other issue that most people don't understand as well, is that insurers make income out of investment yields, and you've got historical low investment yields as well as high cat, social inflation, COVID. You've got a lot of different things all happening at one time, and historical low rate environment.
It's a perfect storm.
Yeah. So, okay, no, thank you for that, and it's certainly good to know that we're aligned in thinking that. So let's move into the panel discussion itself, and what I wanted to do was really focus on 3 key areas. So relationships, and particularly insurer-client relationships, sustainability of capital and of product, and then execution, and particularly execution as we think about risk transfer. So perhaps, David, I'll start with you. Insurers have forever preached the importance of relationships and continuity. And over the past 18 months or so, we've seen an unprecedented portfolio remediation across our industry. Is this belief of the continuity and importance of relationships is that belief and strategy a thing of the past? And should buyers think more short term about their risk transfer strategies going forward?
Yeah, thanks, Ben. I've been in the industry for 34 years, and I would say at the moment relationships are more important than they've ever been before. What I will say, however, that relationships need to work for all parties. They obviously need to work for the client, they need to work for the broker, and they need to work for the insurer. If the insurer is the capital provider, in order to attract capital, you've got to be able to show a return on that capital. Otherwise, the money will be invested elsewhere. From the slides you're showing, there's a lot of negative returns in the insurance industry at the moment, and some really tough decisions are being made on certain segments of business. So I think relationships are absolutely important, because if there's no relationship, it becomes a commodity buy, and then a lot of other decisions are made whilst the relationship still ensures how do we try and get a right deal for all parties involved.
I think understanding the insured's business on a long-term basis is absolutely critical. I mean, for us as an industry, we're here to provide sustainable long-term capacity, right? So portfolio reviews are really, from an insurance perspective, a temperature check on our business, on our lines of business, on our profitability. So having that open dialogue, that long-term relationship is key. I mean, you look at a couple of current situations that we're dealing with. I mean, Ben, you mentioned climate change, and talking about climate change, what's the impact on our insureds in the context of natural catastrophe exposures? I mean, this is a relatively recent dynamic that we need to engage with our insureds and understand their risk exposures. Or you talk to exposures such as cyber. I mean, we've had a 450% increase in ransomware attacks, right? So exposures in the context of cyber are very real for every one of our insureds. And I think, certainly, from where we sit, cyber really for us is the next pandemic. So, and these are the sort of discussions that really need to be ongoing, and for us to understand where the insured's perspective in that regard.
Thanks, Dimitri. Craig, got anything to add to that?
I'd really just echo what Dimitri and David have said. I think it's particularly important that the relationships are built to very much Dimitri's point about understanding businesses, but I think also there's been a change in the dynamic between the relationships that we have with our broker community as well. That's doubly important. That the three parties in the transaction, we can manage expectations, clearly communicate our issues that we have as an industry, so we can get some client understanding about the things that we need to do, going back to David's point, to be able to return that level of profitability out of the capital that we currently attract.
Okay, thanks, Craig. So I mean, you talk there about the need to, I guess, make sure that you're protecting your portfolios, but managing expectations as well. And obviously for a number of clients, it's an expectation around coverage, an expectation around pricing. But there are big swathes of the market now that are either partially or substantially uninsurable. I mean, what's your message, as insurers to that part of the market today?
Dimitri, again?
Yeah. Okay, so bit of a play here, but look, it's really us working with our insureds and having that willingness to engage, right? And I think with the current environment and going forward, there is a substantial amount of unknowns, and really it's about talking to us about what options do we have when you're looking at a renewal program, looking at alternatives, talking to, for example, your self-insured retentions, talking to and giving us the ability to also, as insurers, consider arrangements such as, placing ventilating capacity through a tower. Looking at alternative risk solutions is obviously even more important these days, whether you're talking about captives or, for example, if we're looking at an insured where there's some long tail frequency liability losses, looking at suggested solutions like a deductible reimbursement program. And I think to your point earlier, Ben, the last summer in Australia there's been $5 billion worth of weather related losses, and as you said, we've had increased losses in the property space. We've had increased rates over at least the last 4 years. It's increasingly challenging at the moment for insurers to buy reinsurance, FAC reinsurance, and so it's important for insureds when they're coming to us and talking to us about their programs that they provide us with good quality data. I mean, really, the question is, how do you attract capacity to your account? I think that's really critical.
I'll add to that there's an insurance component which we have to own as an industry, but there's also another component which is, in Northern Australia, how do we as an industry better talk to government around resilience, changing building codes so when cyclones do hit Northern Australia, and we know they will, that the loss profile will actually be better than what it is today. How do we stop risks being built in floodplains? How do we stop when we've got some communities in Australia who are actually exposed to riverine flood? How do we actually talk to government about better protecting those communities? Insurance is one part of it, but we actually need to improve the profile of risk to be able to get affordable insurance.
Thanks, Tony. Craig, have you got any?
My view on all of this is the challenge for us as an industry, going back to the points that you raised before, Ben, about the pressures we're under. The challenge for us as an industry is still to maintain our relevance, to be solution providers, be very clear about what we're trying to achieve. David makes a very good point about it's not just for us as an industry to fix all of these different issues. But I think we need to maintain our relevance, and for a lot of the larger clients, that's going back to Demetrius' point about trying to find solutions that may not have been something that people thought about 2-3 years ago.
So I think that's absolutely right. I guess one of the questions I was keen to ask around that is, if we go down that path and we're buyers are thinking about risk transfer in a different way and maybe taking on bigger retentions or maybe choosing not to risk transfer at all, does the industry run the risk that these buyers in leaner times for insurers, if I can call it that, they don't come back? I mean, is that a concern for you as an industry?
Well, I just jump back on that and talking about our relevance. I think what we as an industry need to be focused on is that we have clients coming out the other side of this process. Clearly we've got some challenges from our financial outcomes, but we also need to be client focused to make sure those clients don't leave us totally as an industry.
Okay. Well, thank you. Well, maybe I'll sort of change tack a little bit here and talk about the appearance of a growing disconnect between clients' needs to get early clarity around terms, for budgeting purposes or for risk and audit requirements, and the insurer's ability or willingness to be engaged early enough in the process or provide that clarity early enough in the process. How can buyers navigate this this challenging position? David, do you want to start?
Yeah, it's not a fantastic position at the moment where the timings are very different to what they used to be. My only advice is the earlier you can engage the broker or the broker engages yourselves and the insurer, the better. I would say that what used to be 3 months is now 6 months or 9 months out from the actual due date. And look, the other piece of advice I'd give is when you provide your data, make sure it's as most up to date as it could possibly be. Because if during that process you revise your values or whatever, it puts the insurer back because it's got to be remodelled. So it's actually taking further time to actually do that project. So the earlier you can do it, the more accurate you can do it, and just the engagement with the insurer is key.
Yeah, I think, to mirror David's points, early engagement and transparency is absolutely key. I think that's paramount, particularly when you're coming up to your renewal. Early engagement, absolutely key. Have a plan to market. So work with your broker to talk to what your process is going to be in the context of the renewal, and then meet with your insurers. I think that's critical for the understanding of the insurer of your risk. Presenting your own challenges and trends as a risk manager. And vice versa for us as insurers to be able to present to our insured just as to the state of the market. So that's another important factor. And I think also when you're engaging in that regard and providing the most recent up-to-date information, to David's point, is critical. Data is critical, and I think another point that I would raise is that there's a lot of uncertainty in the current environment, which we all know about. But engaging your C-suite early in the piece is also particularly important. I suppose bringing them along for the ride and getting them to understand the challenges within the context of your own renewal, but also the challenges in the context of where we sit as an insurance industry.
So just with that, Dimitri, maybe I'll ask Craig this. I mean, we've got quite used to, WebEx or Zoom, meetings with, between insurers and clients, and I dare say, I think we're getting quite good at it as we get through this year. How important is that? And actually, I mean, to your point, Dimitri, around engaging with C-suite. I mean, how important is it that we actually get the right people in the room for those conversations? Craig, do you want to?
To me, it's all about being very clear and transparent around the messaging that each of the respective insurers has got, the challenges they've got. I think engagement at any level in the organisation is critical. I think I've certainly seen engagement within the organisation I work for at a senior level a lot more prevalent with clients than it has been for a long period of time. You're right, we're working in challenging communication areas, but I think it's quite efficient. So as many people as we can get into the conversation and be very clear about the challenges we have can only be important to the process. The only thing I will say about engagement, I think one of the biggest challenges we being client, broker, carrier could run into is early engagement's great, data's fantastic, but at the moment the whole industry is changing portfolio mix very quickly, changing rating structures very quickly. So you could get to a situation where there's a last minute pivot on risk appetite, or my organisation made an announcement 2 nights ago that we're exiting some business in the UK. That's happening now. So I think you're going to see a lot more of that, I suspect, in the next 12 months.
Yeah, the dynamics of the market are changing very rapidly at the moment, particularly in the last 12 months, and oftentimes it's a month-by-month, quarter-by-quarter proposition. So
a lot of these things, I guess, are coming from there. I mean, they're global, global initiatives, global mandates, and I guess we talk about engaging of C-suite at the client side. I mean, how important is it, do you think, to actually engage various stakeholders, I guess, at a global level, particularly when, I guess, we're able to have this kind of environment on WebEx and Zoom more easily. How important is it to maybe engage, I guess, yourselves, particularly, I guess, AXA XL, Chubb, as global insurers at that sort of level? Is that helpful discussions, or is that unnecessary in your mind?
I think getting engagement's really important. Sorry, Dimitri.
No, I completely agree. I think, whatever level of the organisation that you're looking at, I mean, I'm certainly engaging our senior executives a lot more these days. I think, and I shouldn't just say these days, I think it's critical to to ensure that our brokers and our insureds are happy to come to us and engage, and for us to be as transparent as possible, whether we're in the current climate, which is particularly difficult, but also on an ongoing basis. I think it's critical to be able to have that banter, to be able to understand each other's positions.
Okay.
Yeah.
So, David, we talk about the need for clients to differentiate, and I guess we've sort of for a while now we've looked at differentiation in terms of getting a better deal. It's probably actually more now about getting a deal in many environments. I mean, how important is differentiation to you as you go through the underwriting process in terms of, I guess, risk quality or other metrics?
I think it's really important. You're actually competing against other clients for the use of the insurer's capital. So what I would suggest is don't roll out necessarily last year's presentation. Talk to the broker around what are the key parts that the insurer is actually looking for, and how does your organisation, how can you actually add value to that conversation that will get the interest of the insurer to actually put up capacity on that account.
Anything else on that?
And the quality of the underwriting submission is paramount. The amount of data that you provide us, quality data, as mentioned earlier, is important for us to be able to make a decision and come up with solutions, not necessarily just one solution, but perhaps options. So, yeah, underwriting submissions and early receipt of underwriting submissions is important.
So I guess one of the frustrations that many of our clients have voiced, not just locally but globally over many years, is the amount of information that needs to be provided. I guess the message there is it is needed.
Yeah, I think there wouldn't be an insurer out there that's not looking at portfolio remediation at the moment. So you are competing for a part of that portfolio, and being able to differentiate the risk is critical. Probably more so now than it's ever been.
Well, thank you all, and I'm afraid we're out of time. I think we could have probably debated some of those topics for hours, but perhaps we'll get an opportunity to come back to this discussion in the not too distant future. But again, a massive thanks to the panel, and perhaps I'll think about the conversation and just summarise some of the things that we've spoken about today. I think we spoke about relationships, and I think by the sound of it, it seems to me that relationships are more important than they've ever been, but we perhaps need to adapt those relationships and those conversations a little bit from perhaps where we've been in the past. I think buyers need to try and understand an insurer's needs in order to make the right decisions and to make them in a timely manner, and the differentiation and a strong articulation of risk quality is absolutely paramount in a reduced capital environment. So those, to me, I guess, are the three key takeaways. And again, I just want to take this opportunity to thank the panel again for sharing their wealth of knowledge and insights on these topics. And hope that's been useful for the audience. And thank you for